Hi, this is Mike Maloney, and this is your gold silver market update for Wednesday, March 11th, 2020. And I want to point out this picture here on the screen. This is a snapshot of a television screen. You can see the reflections of the windows in the background. But at this point in the day, a couple of hours ago, the Dow had already dropped 1,200 points, and the World Health Organization finally declares the coronavirus a pandemic. They are about a month and a half late on this one, folks. And I will be surprised if that month and a half late on this doesn't add up to tens of millions of deaths, at least millions, that they will be directly responsible for withholding information, trying to keep the public calm. We don't want the markets to go down. So anyway, getting into the news. Gold and silver are both down, but they're down very little. The markets are down much, much more. The markets are crashing again. The gold-silver ratio is holding up. Now, the markets went down, which sometimes draws down the precious metals because of margin call, but the dollar also went up. So that's part of the reason that that gold and silver are down. But the gold-silver ratio is holding in there. Meanwhile, some of these headlines, sporting events are being canceled or being held without fans. Can you imagine the Super Bowl with nobody in the audience? And what a loss that is to the producers and to the sports teams. How stock market circuit breakers work. We're going to get back to this one in a moment. The World Health Organization declares the coronavirus outbreak a global pandemic. 140 billion in energy debt at risk of imminent downgrade to junk status. That's because of the low oil prices. U.S. dollar buoyed by stimulus optimism. So all the people in the stock markets are hoping that the Fed is going to throw a bunch of currency at the problem. And so that was when the stock markets were still above the previous low from 2 days ago. But getting back to this story about the Fed vice chairman, Alan Blinder, former Federal Reserve vice chairman, puts a recession odds at 90%. I've got news for you, Alan. It's 100% at this point, without exception. There is no way of escaping a recession. My bet is that a global depression is actually a greater than 50% risk. Moving on. What has happened since like an hour and a half ago in that snapshot of the my news on my website? My best friend of 50 years has been working furiously to get you the best stories as quickly as he can get them. Recession, White House, Congress need to move quickly on stimulus. Well, they can't really cut interest rates more. They will. They'll go down to zero. They'll go down to negative, but they're going to print a lot. Circuit breakers back in play on the stock exchange, nearing bear market. Treasury yields next to nothing, and they are no longer a hedge that they used to be. So the only real hedge that's left, the only safe haven, is going to be precious metals. And that means precious metals to the moon. Dow drops deeper into bear market territory, now down 1,600 points. That snapshot, it was down 1,200 points. Fed increasing overnight repo rate from 150 billion to 175 billion, and we'll get to that in a moment. Dow crashes into bear market territory. It's the fastest drawdown in market history. So going from the peak of this market to where we officially enter a bear market, which is a 20% drawdown, this is the fastest in history, faster than the crash of 1929. Virus is at Bear Stearns moment and may get worse. And this is from former Treasury Secretary Larry Summers. And I've got a clue for you here, Larry. It's not at a Bear Stearns moment. We're already at the Lehman Brothers moment. Bear Stearns happened months before the Lehman Brothers moment. You'll see how quickly this thing starts playing out now because of the bungling of the Center for Disease Control. The New York Stock Exchange takes steps to keep coronavirus from the trading floor. Senate Democrats asking Trump to declare a national emergency on coronavirus. Window of opportunity to mitigate coronavirus, but Congress must act fast. Too late. I mean, That should have been a month and a half ago. That was the only way to get ahead of this thing. On the radar, I want you all to go to Chris Martenson, DOTCOM, that's the YouTube channel, chrismartenson.com, and subscribe to his channel, and then go to Peak Prosperity and subscribe there. But this is from Mark Baker. Thank you, Mark. The total number of confirmed U.S. coronavirus cases of each Tuesday. So each one of these is a week. Now, Chris Martenson videos, you'll see that he does case, cluster, boom. That's sort of the theme. And what we have here is January 14th, there was 0. January 21st, a week later, 1. The 28th, there was 5. So between the 1 and the 5th, you've got case, and same thing, case, and then case like per day, cluster, boom. We are at the boom phase now. It's already in much more than half of the United States at this point. Just a couple of days ago, I got a text from my brother. Stop scaring my wife about this preparation for this thing. It's nothing. The flu kills more people. Well, we'll see what he says. After a year passes from now, it's going to look very different in the United States. Everything will have changed. The economy, and we will have seen millions dead throughout the world, possibly tens of millions, possibly more than 100. This is the worst thing since the Spanish flu. Go take a look at it. Goldman, after 11 years, we believe the S&P bull market will soon end. Ha! Sorry, it's over with. It's been over with. This is the Fed boosts size of repo bailout facility for the second time in a week following the liquidity collapse. And it says down here, the market's biggest demand yet for liquidity from its repo facility. The Fed has increased the size of its daily bailout facility. And you see here a $175 billion limit. And then you see this jump over just the past couple of weeks here, in all of the repurchase agreements that are taken out on a daily basis. And the rest of this article goes on to say, this is the second time this week, after ramping their facility from $100 billion to $150 on Monday, beginning Thursday, March 12th, and continuing through next month. So this is a month long. They're announcing the desk will offer at least $175 billion per day in overnight repos and at least $45 billion in 2-week term repo operations. So it's 75 plus 45. Additionally, the Fed is offering 3 1-month term repo operations. And so the amount offered for each of these will be at least $50 billion. So they're basically they're printing currency, and it's huge. And these are emergency loans. A repo operation is when a financial institution needs capital quickly. They got to have it right now. And so there is a repo market that operates without the Fed intervening, and they didn't intervene from the start of QE until just last September. There was no repo operations being done by the Fed. There was the private repurchase operations, the repurchase market. But the Fed jumps in when they want to manipulate short-term interest rates without actually these become, they're buying short-term bonds. And you saw this in my video of last week. I showed how the 3-month Treasury had collapsed in just 3 or 4 trading days by 500 basis points. The day before, Jerome Powell, the Federal Reserve, announced that they were reducing the Fed funds rate by 500 basis points. So they had already manipulated the 3-month Treasury down that far. Welcome. 1,038 new subscribers. And just remember to hit these things, click the notification bell. And the charts of the day, I say charts this time, these come out of my new book, The Great Gold and Silver Rush of the 21st Century. But I need to give you this information ahead of time because my chapter on the almost everything bubble is changing minute by minute. I had hoped that this boom would go on for a few more months, but the coronavirus isn't a pin popping the bubble. This is Dirty Harry with his magnum popping the almost everything bubble. And it's not the everything bubble like everybody else says. It's not the everything bubble. It's what my chapter is and what I've been referring to it as for the past couple of years. 4 years ago, I was referring to it as the everything bubble. Then I changed my tune because I was wrong. It's the almost everything bubble. The only things that I can find that aren't in a bubble are gold and silver. But this is a piece from a chapter in it, the almost everything bubble, a recovering stockaholic. A 58-year-old friend of mine has bet his retirement on the stock market. He figures that steady contributions into his individual retirement account, his IRA, will mean that he can retire at 65. Well, he's already 58. I tell him that other than some cryptocurrencies, precious metals have been the best performing asset class of the century, and I include charts like this one to prove it. So this is the S&P 500, the percentage gains, the performance since gold hit its low in 1999, and then it made a double bottom, and there was $3 difference here in 2001. Then there was the stock market started its plunge in the year 2000. Now, inflation adjusted, this looks a lot different, and I'll show you that in a minute. But this chart is old because it's a snapshot out of my book. The gold was up over 550% for a little while. It has done a pullback, but so has the S&P, and its pullback has been even greater. So the S&P is only up about 120% from where it was in the year 2000. And if you inflation adjust that, it's a lot worse. So I told him that it actually took 17 years for the stock market to recover from the crash of 2000, and that investors never knew what hit them because they couldn't see it. This was an invisible crash. And then I gave him this chart of the S&P divided by the Consumer Price Index, the CPI. So you can go to stockcharts.com and type in $SPX, that's the S&P 500, colon means divided by, $sign CPI is the Consumer Price Index. So you see the S&P Large Cap Price Index divided by Consumer Price Index, and the peak in the year 2000, and then the tech crash, the real estate bubble crash, and it took 17 years to get back to break even. Now, to everybody that's got an IRA, they're contributing because their business matches their contributions of 401k plans and such every month. So to them, when they got to this point, they were seeing new highs. Oh, my IRA's up. Well, no, the stocks that you bought before that you had bought before this had all crashed, and they hadn't even gotten back to break even yet. And then they keep on contributing, and they probably got, even after the global financial crisis of '08, they were probably up at some new highs back here, but all of those old stocks that they had bought hadn't even broken even until the end of 2017. His reply to seeing this chart was, yeah, but if you just stay in the stock market over the long run, it goes up an average of 8% per year. Well, that's when you average 100 years. Wall Street doesn't care. This is me saying this. Wall Street doesn't care about the small investor. Whether you win or lose, brokers always make their commissions. As Eric Sprott of Sprott Asset Management so eloquently put it, the privileged few on Wall Street need the little guy. He is the indispensable part of the food chain. He is the plankton of the financial world. Most companies, especially those in the financial industry, need to feed off the little guy in order to thrive. So if you want to be the plankton of the financial world and have these people feed off of you, let some broker run your IRA for you and stuff. But for me, I stayed away from IRAs. I control my own destiny. I never give financial advice. I just tell people what I'm doing. Some viewer feedback as to yesterday's video, what's wrong with silver? Carrie Zinn says, can you talk about when investors would buy silver? What are some of the factors that will drive investors to push silver instead of gold? Well, what I can tell you, Carrie, I think you're talking about when silver starts outperforming gold, when investors finally rush in. But smart investors are buying now and have been buying for the past decade, basically. I've been buying since 2002. I've never stopped. The smart investors are accumulating now, getting ready for what is now beginning to unfold. And this crisis, if Ben Bernanke had, that was the Alan Greenspan bust. The tech bubble bust was Alan Greenspan's fault. The 2008 global financial crisis was Alan Greenspan's fault. Ben Bernanke was left there to clean it up. Now we're entering the Bernanke bust, and Jerome Powell is the guy that will have to clean it up. But what Bernanke did with his interventions, he did not allow the markets to clear out all of the excesses and to let the bad companies go bankrupt and to let the economy start from a fresh place. He kept the virus of currency creation, the virus of low interest rates, he kept that all alive and actually fed it. And now it's about to infect everybody. Right now, this is the deflation virus, but it's going to turn into the inflation virus. But as people rush toward gold, that gold-silver ratio will probably go up toward 120, I suspect. But it's when it gets to some big round number. But the thing is, get my book. You can get it at goldsilver.com for free, and it's got all of this information in it. And I've said this information many times before. Do a search on YouTube, and you can find where I've talked about this many times before. But when gold is going past 2,500 or possibly 5,000, that's the point. And the gold-silver ratio is at 120. People will look, they'll take $5,000 out of their account, rush into a coin shop and say, I want to buy gold too. And they're going to plop 1 ounce in their hand. They're going to go, oh, is that all I can get? Well, how much is the silver? Oh, well, you can get 120 ounces of those for each ounce. Oh, well, give me the silver. That is exactly what happened in 1979, and silver just blew the doors off of gold at that point, and it's exactly what's going to happen again. The quote of the day. But first, go to my website, download the book. It's free. It's the best-selling book on precious metals of this century, and it's been the best-selling book on Amazon and Barnes & Noble and everybody that was selling books for years. And I want to give it to you for free now on my website. It's still the best-selling book on precious metals. And so it's free. Go to the website, go to goldsilver.com and download it. And all the information that you're asking about is in there. And it's still pertinent today because Ben Bernanke didn't allow the full crash of 2008 to play out. And so he stopped the flushing out of the system and the clearing out, and it's all infected with everything that was in there before. And I updated it in 2015. And so it's still pertinent. It's still right today. And you're going to see what is good. You can see the future if you look into the past. And you know what? Only like the last 20% of this book is about investing in precious metals. The other is a real short and entertaining monetary history and how it affects you today. It's some very simple economics so that you can get your head around what's happening. It's some potential outcomes, and then it's about precious metals. So the quote of the day: we have gone to the restaurant, we have eaten the meal. Now, the only question is whether or not we will pay the check. And that comes from the Senate Finance Committee chairman. Now, I would rephrase that. It isn't the only question is whether we will pay the check. The question is who will pay the check. The check will get paid. The check either gets paid through default, where the U.S. defaults on all of its bonds and says, sorry, we're not paying anybody. If it does that, then everybody that invested in bonds is the one stuck paying the check. But what they're going to do is they will end up inflating their way out of this, and they're going to devalue the dollar. And in that case, it's us that pay the bill, you and me, except if you've got a bunch of gold and silver, the only portion that's paying the bill is the cash that's being devaluated. Otherwise, that devaluation causes gold and silver to go to the moon. Thanks a lot for listening, and we'll see you next time.